What's going on, everybody, and welcome back to Exploring Investments with Justin. In today's video, I'm going to be talking about what an ETF or exchange traded fund is. And the reason I'm putting out this video is because I want this to be a channel where not only do we analyze stocks, but we also educate new investors. And I think it's important to talk about ETFs because it is a different type of investing than individual stock picking, and not all investors can handle the volatility of individual stocks. So if you're new to the market and you're looking at different ways to invest your money, this will be the perfect video for you. And be sure to let me know in the comments section whether you're an ETF investor or an individual stocks, because I am curious to know what kind of investing style my viewers and subscribers have. And make sure to hit that like and subscribe button because it does help out the new YouTube channel. And real quick, before we jump into today's video, I do want to let you know that I did create a Discord chat, and that'll be the first link in the description as well as a pinned comment with that link. So be sure to check that out, and without wasting any more time, let's jump right into the video. So an exchange traded fund, also known as an ETF, is essentially a collection of securities or stocks that often track an underlying index like the Dow Jones, NASDAQ, and S&P 500. And these can also track that of different industries like the tech industry, healthcare industry, and real estate industry. So you can really think of it as buying a fraction of a share from hundreds of companies and putting that all into one stock. That's essentially what an ETF is, and we'll dive more into that later in the video. So what I'm showing you now is the makeup of one of the most popular ETFs, which is the SPY, and this tracks the S&P 500, and hopefully this will make more sense of what an ETF is. So we can see here that the SPY is well diversified, with the ETF having stocks from several different sectors, with 21% in technology, 15% in healthcare, 14% in financial services, and many other smaller sectors. And within these sectors, you have exposure to many stocks, including Microsoft, Apple, Amazon, Facebook, and many other large and mid-cap companies. So this is one of the things that makes ETFs enticing for investors, is because of the diversity you get from each ETF, since they're made up of hundreds of stocks. And sometimes these ETFs will have a weighted average, so usually if the top 10 holdings are all moving up, this will make the S&P and conversely the SPY ETF move up as well. So now that you know the definition of what an ETF is, I think it's important to know what the pros and cons of this type of investing is. So the first and biggest benefit, in my opinion, when it comes to investing in ETFs is the exposure you get to the broader market. As I said at the beginning of the video, when you buy a SPY ETF, you're buying a small position in some of the largest companies without having to pay $3,000 for a single share of Amazon or $400 for a share of Apple. And what this means for you as an investor is that when one industry is lagging behind the rest of the market, it won't destroy your portfolio because your risk is spread out through several different industries. Now, the second pro, in my opinion, is the consistent returns you can expect to get from ETFs. Now, on average, the three major stock market indexes will go up anywhere from 7 to 10% each year. And of course, there will be some years where the market goes down and others when it's up 20+%. But in general, you can expect an annual return of 7 to 10% on your investment. And this is one reason a lot of people choose to invest in ETFs, is because it's almost like a guaranteed return. When you're picking individual stocks, there's a lot more risk because some companies don't go up every year. And to prove this point, we'll look at the example of Ford stock versus the SPY ETF. So what you'll see here is that over the last 5 years, Ford is down more than 50%, which means that this would have been an awful investment if you were buying individual stocks. On the other hand, if we look at the SPY ETF, we'll see that over the last 5 years, you would have actually gained 54% on your investment. And if we compare that to the S&P 500, you'll see that the SPY ETF was within 1% of the S&P 500. So like I said, investing in ETFs is a safer investment than individual stocks. But as the saying goes, there's no reward without risk. So with ETFs, there's less risk than the individual stock, but also less reward. And many investors are okay with this because of my third point, which is that ETFs do not need to be actively managed. Investors can buy into the ETF and not have to look at it for another 20 years because they know that over the long term, the three major stock market indexes will always go up. Now, with individual stocks, you have to constantly be paying attention to company valuations, company growth, and their stock price to know when it may be a good time to either take profits or cut your losses. And when you combine these three factors, that's why many investors choose to go this route. They get to diversify their portfolio and get exposure to hundreds of companies. They get consistent returns that help them keep up with inflation, and they don't have to actively manage their portfolios because they don't need to worry about whether or not a company's valuation has become too rich. So now that we've covered the main benefits of investing in an ETF, let's quickly look at what the downsides are. So the biggest drawback, in my opinion, is the opportunity to find companies that Wall Street has either not recognized yet or have beaten down, like we saw with Tesla. And for this example, let's look at Apple stock versus the SPY ETF. We can see here that after hitting the March lows, Apple has rebounded more than 70%, whereas the SPY ETF has only gone up 45%. And I would say that's a modest comparison because there are a ton of other stocks that have gone up more than 100% since the March lows, like Tesla and Uber. So the biggest advantage to picking individual stocks versus ETFs is just the potential gains you can make from finding stocks that have high growth moving forward and are trading at cheap valuations. When it comes to ETFs, you don't have that same kind of upside potential because your risk is spread throughout the market, which means a big upward move in one stock will not have a significant impact on that ETF as a whole. So in the end, I think it really comes down to what kind of investor you want to be and how much risk tolerance you have. If you can't handle the volatility of individual stock picking, then I think ETFs are a perfect alternative, especially if you just want to put your money somewhere and forget about it for 20, 30 years, where you can come back and see that your investment has grown significantly. And there's nothing wrong with that, it's just a different style of investing. So be sure to let me know in the comments section if you're more of an ETF investor or if you like individual stocks, because I'm curious to know what kind of investing styles you guys have. And so with that being said, I just want to say thank you guys for watching, and I will catch you on the next one.